What is going on, guys? Today I want to shoot a quick video talking about one of my favorite short-term options trading strategies. So let's go ahead and dive into it here. So definitely want to throw a disclaimer out there. Not a financial advisor, so use this video for educational purposes only. Make sure you understand your risk before implementing something like this, and make sure you understand your risk before ever touching options, right? Because options are a lot more volatile than just normal stocks. So definitely make sure you do your research before implementing any types of option trading strategies. So this is on the Fidelity platform. Start out some of my personal information here, but the strategy that I want to talk about is specifically called a buy right strategy, right? So it's essentially buying stock and immediately selling an option against those shares. So for example, Tesla currently trading around 241, right? So if you're not familiar with kind of what a covered call is, right? So you have to own 100 shares. Don't mind my terrible handwriting here. But so say you own 100 shares at 241, right? And you sell a covered call at 250. Hope this makes sense. So if it runs up to 250, right, you're making $9 roughly in capital appreciation. And oftentimes if you sell a call, you're capping your upside, right? So if it goes to 280, if you sell a covered call, you're not going to get that upside. So that's the cons, right? So, but if it never reaches this and you sell it for like $2, it'll be like 250, right? 250. It'll say $2.50, but that equates to $250. So if it never shoots up there, if it goes up there, it gets close and then drops before the expiration, you'll be hedging your downside. You guys can't quite see that. It's going off the screen there, but that's kind of like high level, what a covered call is, right? So let me unselect that. Remove. All right. Okay. Let me get rid of this. Okay. But the strategy I want to talk about is a buy right strategy. So for this instance, you're buying 100 shares. The thing different with this is whenever a buy right strategy is you're immediately entering this call position whenever you purchase it, compared to if you dollar cost average into a position, you buy 25 shares of a stock once a week for 4 weeks. After 4 weeks, then you could sell a covered call. This difference, a buy right, is you are immediately being in a call position as soon as you purchase this stock here. So in this instance, right, so today is Saturday, but this upcoming week, we're going to have an expiration date on this upcoming Friday. Tesla's currently trading at 241. If you were to buy 100 shares currently at that price and immediately sell a 240, I know it's below your cost basis, but the thing with this option is it's currently $1,300. So really, you'll be selling your shares away. So your risk is the cost, right? So it's not necessarily 241, and that would be if you purchased 100 shares, your max risk would be $24,000 and some change there. But since you're doing a buy right, you're entering a position and you're immediately reducing some of your risk, and you still have the ability to make some money on the upside, and that money is $1,250, right? So that's that, and that's kind of the breakdown, right? So if you're more conservative, you can sell an in the money call option. Just make sure it's the premium is which it might not, the lower we get down here, our max loss is going to drop, but we have more of a hedge to the downside, right? So $700. We're immediately purchasing Tesla, and we're taking on a lot of risk, and we're only getting a little bit of gain there. But if you're not completely bullish on a company, this could be a way that you can enter a position and immediately be hedged to the downside of roughly $20. Now, if it shoots below, 220, you're not going to be protected anymore. But just kind of keep that in mind there. So this is a buy right. I like to implement this strategy just on tickers that I kind of want to trade on a short-term basis, right? Obviously, if you have a long-term position, you may not want your shares to get called away as often. So then you could sell something really further out of the money, right? So we're for 240, and you don't think Tesla will hit 260 by this week. So you don't think Tesla will shoot up $20. This could be another strategy that you can implement. And, if it does, you're going to be making a good bit of money here, roughly over $2,000 if Tesla does shoot up. But if it shoots to 280, just keep in mind you are capping your upside there. So for this instance, let's pull up this pen again and see if I can make it a little bit cleaner for you. So you purchased 241, right? 241 is your cost basis, 37. And you immediately sold this call option for, 519. So that immediately reduces your, you subtract $5 from this, sorry, this is terrible writing. I'll try to get better at that. But your new basis is right is 235.80. So you're opening a position on Tesla, 100 shares of Tesla stock. You're immediately selling this 260 covered call. It's reducing your basis all the way down to 235.80, and then so forth there. If Tesla just kind of chops and doesn't hit 260 this week, this money or this premium will be 100% yours to collect, right? You can either buy to close. So, as we get closer to this expiration date of Friday, there's a thing called theta. You can't see it on Fidelity's website, but that's pretty much what it's a component of the value of this covered call, right? So, and the idea with theta is that as we get closer to the expiration date, the price of this, if it's not in the money, it's going to go to zero potentially, right? The end goal, 0, 0. So if you get paid $5.50, as we get closer to this expiration date, it's going to get less and less valuable, right? So that's the scary thing with buying and selling call option or buying options on a short-term basis, right? Your time is running out. And when you're predicting the price of a stock or ETF, you have to be accurate, right? Not only do you have to be accurate on the strike price value, but the expiration. So just kind of keep that in mind. But high level, buy right. This option strategy is one that I like to use quite often. I also do this on dividend stocks that potentially have an X date. X dividend date, div date. That's another, I'll shoot another video kind of talking about that, but you look at like Starbucks, any dividend stocks that has an upcoming dividend, X dividend date rather. So say their X dividend date is on a Thursday. It's just another way to kind of hedge your downside. If you're able to hold that stock on X dividend date, because you're going to be pretty much, if you own a stock on X dividend date, that entails you that you're going to be paid out whatever dividend they are paying. So if you sell call options around X dividend dates, sometimes you might get assigned early. If the option buyer of that contract wants that dividend, you're going to get exercised early, which is great. If you're okay with the shares getting called away and you not getting the dividend, I'm fine for that. That's happened to me several times. So just kind of keep that in mind. That's another little bit more advanced strategy, but more specifically for dividend stocks. I'll shoot a video maybe coming up on the next opportunity that I come across for doing something like that. I've done it with Starbucks and Nike and some other dividend paying stocks before and kind of illustrated it, but I'll definitely do another one in the future on that. But high level, this is the buy right strategy, right? So you're buying stock, 100 shares, could be 500 shares. Just got to be in increments of 100 if you want to sell a call option there. So hopefully this was valuable. Hopefully I didn't complicate it. Options can be definitely tricky to understand. So please, for my sake and your sake, do your own research. Don't just buy stocks, high IV stocks for the option premium. Make sure, if Tesla, if we would have done this a couple weeks ago when Tesla tanked, you just have to be willing to hold whatever you buy 100 of, right? This is a pretty big investment of $24,000. You have to be willing to hold it if things turn in the market. And they definitely have turned recently over the past weeks and past month. So do your research, make sure you understand the risk, but this could be a really helpful strategy to implement. I really am a big fan of it. Sometimes I don't enter it exactly. So sometimes I'll just buy 100 shares of a stock and then wait for it to potentially go up a little bit. That way I get a better value on my position. Then I'll sell a covered call, or I'll sell in the money covered call to kind of hedge my downside a little bit. But yeah, hope you got something from this. Let me know your thoughts down below. Comment section down below. Would appreciate any type of feedback you guys might have. Let me know if you like selling covered calls, if you like implementing the strategy. Just keep in mind, you are capping your upside, right? So if you want upside, or you don't want a tax of, this capital gains potentially happening, make sure you understand the risk with covered calls. You're pretty much selling a limit order, right? You're selling a limit order and you can't change it. You can always roll it, but selling a covered call is saying I'm obligated to sell my shares at said strike. So just kind of keep that in mind there. So yeah, guys, that's going to be it for today's video. Please like and subscribe down below if you got any value from this, and stay tuned for more content coming out in the future. Cheers.